James Sahagian. I'm the managing director at Ramapo Wealth Advisors in Ramsey, New Jersey. And today we're delighted, I'm delighted to be joined by my colleague, Alex Tirso, who together will be taking a look at the recent market correction. We're going to take a look back at the last 5 years and give us some historical perspective as to where we've come from. And lastly, we're going to provide you, our valued clients, with some recommendations on actionable steps to take and thoughts about how we can navigate the markets most effectively. So it's important to note that 5 years ago, right now, the market was going through a very severe correction as the COVID-19 pandemic took hold. We're almost exactly at the market lows of March 23rd, 2020. So it's almost exactly 5 years since that occurred. And it was an unprecedented event in our lifetimes. You'd have to go back to the Spanish flu of more than 100 years prior to have something similar. And we were faced with an environment where everything shut down. The economy came to a complete standstill globally. And there was, hundreds of thousands, millions of people perhaps died from the pandemic here in the United States and tens of millions around the world. Remarkably, that was a period in which the S&P 500 sold off by more than a third, more than 33%, a 6-week period of time. It was the sharpest decline we had experienced in our lifetimes. And the market, the S&P 500, bottomed at that time at about 2,200. To give perspective, today we're at about 5684 at this moment on March 20th, 2025. So we went from about 2,200 to the current level of 5684 over the past 5 years. And that's after we just went through a 10% correction from February 19th, just a month ago yesterday, to the market lows hit last Thursday, which marked a correction, which is defined as a 10% drawdown from previous highs. So I thought I'd give a little bit of context as to where we're coming from in the more recent past, because we had a sell-off in 2022 in which the S&P 500 dropped by some 19%, and the NASDAQ dropped by about a third, 32%. But since then, and that sell-off was really driven by inflation and the Federal Reserve's response to the inflation, which was caused by all the stimulus and liquidity injected into the economy by both the Federal Reserve and the US Treasury. And that liquidity created a lot of stimulus in a supply-constrained economy. And everything from the price of homes to the price of cars, used cars especially, shot up. And the demand for services went up in a supply-constrained and capacity-constrained environment. So that inflation caused the Fed to raise interest rates at the fastest rate they ever have. And if you recall, at the beginning of 2022, interest rates were practically zero. And by the end of 2022, we were near 5%. So that dramatic increase in interest rates in a very short period of time caused both stocks to sell off. As I mentioned, the S&P was down 19%, NASDAQ was down about a third, but it was also the worst year in the history of the bond market. So both stocks and bonds sold off simultaneously. Well, after 2022, the market kind of bottomed in October of 2022. We had 2 very strong years. In 2023, the S&P 500 rebounded by about 24%. And again, in 2024, just last year, the S&P 500 was up about 25%. These types of returns are highly unusual. They're actually more than 2 times the historical rate of return if you look at the rate of return of the S&P 500 over any length of time. And this market was very unusual in that it was largely driven by a handful of companies, typically the largest companies in the United States, that have been dubbed the Magnificent Seven. So these seven huge companies, many of them are now trillion-dollar, valued companies in terms of their market cap, are all familiar names, or many of them should be familiar names to you. These are companies like Apple, Microsoft, NVIDIA, Amazon, Meta, also known as Facebook, Alphabet, also known as Google, and Tesla. And these seven companies benefited from the excitement about the prospects for artificial intelligence and the ability of AI, or artificial intelligence, to transform our way of life, increase productivity, providing every single industry an opportunity to improve efficiencies and for us to have a higher standard of living. So the AI craze has really driven these leading companies to the largest overweight that they've ever had. So the top seven companies at the end of 2025 represented 1/3 the entire market value of the S&P 500. So to put that in perspective, if you invested $1 in the S&P 500, 33 cents of that dollar really was going to those seven companies because of their tremendous market value and the weighting that they have on the index. And by the end of 2020, at the end of 2024, given the run-up that they had the two prior years, the valuation of these companies became expensive. So if you looked at the price to earnings ratio of the Magnificent Seven companies, those top seven companies, they represented about 23 times earnings, or the PE ratio, as we say, was trading at 23 times expected earnings of the Magnificent Seven, or of the S&P 500. And the Magnificent Seven was driving that valuation. This is significantly above historical average, price to earnings ratio average of the S&P 500, which over the past 20 years has traded in a range of between 16 to 20 times. So coming into 2025, the market was very optimistic about the AI trade, about the Trump agenda of less regulation, being that he won in November. The market rallied after the election based on the prospects for less regulation, a pro-business agenda that could help propel the market even higher. There is a strong belief that Trump 2.0 will extend the Tax Cuts and Jobs Act 2017, which occurred under his watch in Trump 1.0, and would perhaps even be enhanced, providing for an environment of lower taxes and more certainty, because that Tax Cuts and Jobs Act was set to expire or sunset at the end of 2025. With a Republican House, a Republican Senate, and with the Oval Office, Republicans are likely to extend the TCJA. So that was a cause for further optimism after the election and the Republican sweep in November. So the market continued to rally into the new year, and peaked on February 19th, just a month ago yesterday, with the S&P 500 up approximately 5% from January 1 to February 19th. So with the backdrop of the rally we've had over the really almost 2.5 years, because the market did bottom in October of 2022, peaking on February 19th of 2025, the market has experienced a very sharp and rapid correction. In fact, it's the 5th fastest correction for the S&P 500 in the past 75 years. Well, why is that? That's occurred for several reasons. First, I think it's important to note that the Trump administration has embarked on a policy of government austerity and has been very rapidly trying to cut costs and the size of government. And while that might have positive long-term impacts and is by all arguments necessary, Democrat or Republican would have to admit that we'd have to address our $2 trillion annual deficits by cutting the size and spend of government. Nonetheless, I think the rapidity, the speed in which they're moving, I believe just today they announced that they're going to be cutting and eliminating the Department of Education. They are furloughing and offering buyout packages to tens of thousands, if not hundreds of thousands, of government employees. So the Department of Government Efficiency, led by Elon Musk, has caused some angst to the markets and to the economy, as that likely will be a headwind to economic growth. Secondly, President Trump has come out swinging pretty aggressively at many of our trading partners with tariffs. I think, tariffs are a tax on the American people. They are inflationary and they will likely drive costs higher. But I think what has caused so much angst is the uncertainty that we have regarding the policy. It seems to be quite erratic in terms of how it's being rolled out. Day to day, we don't know what we're going to wake up to and what we're going to hear about in terms of our tariff policy as it relates to our closest neighbors, Canada and Mexico. And likely in just a couple of weeks, new tariffs are going to be rolled out with many of our other trading partners in Europe and in Asia. So this correction has really been led by those two factors, the tariff policy as well as the government austerity initiatives. What we've seen here is quite normal. It is normal for the market to have a correction. Typically, we get one every couple of years. As I said, in the last 5 years, the market has more than doubled, nearly tripled at its peak from the March 2020 lows. Valuations have come down with the recent sell-off, but are still trading at relatively high valuations. But what we've seen is that despite the fact that the S&P 500, which is skewed very heavily towards these leading giant companies, have started to rotate. And we're seeing a rotation from these large cap companies in the S&P 500, large cap growth companies mostly, to other areas like value companies. We're starting to see outperformance in sectors that had lagged, sectors like healthcare, energy, and utilities. International stocks, which have lagged tremendously over the last 16 years, are leading year to date, with the EFA, which is an index of developed international markets like Western Europe, Canada, Japan, and Australia, up double digits year to date. The Eurostoxx index was up more than 12% year to date, and we're not through the first quarter. And emerging markets also have performed. We're seeing a rotation from stocks to bonds, where the Barclays aggregate bond index is up approximately 3% year to date. Similarly, we've seen commodities, precious metals, showing signs of strength thus far in 2025. So I'm going to turn it over to my colleague, Alex Tirso, to cover how we've been able to navigate volatile markets in the past successfully, and to give some perspective on previous periods of market weakness.
Thank
Alex?
you. Appreciate that. Can you just give me a thumbs up that you can see my my slides? Okay, thank you. Perfect. Good afternoon, everyone. Happy first day of spring. And James, thank you for the market update. As he said, it's been a wild ride over the past few weeks here, the past month in particular. So we want to utilize history as our guide, right, to see what has happened during past downturns and how should we be responding, if at all. So we're going to be looking at history and talking more from a principle perspective, as opposed to necessarily tactical perspective. So what has had the greatest impact on investment results? So in front of you right now, you're seeing 30-year annualized returns of U.S. stocks, government bonds, and what has inflation grown at. And then we see investor behavior on the right-hand side of this slide, right, at just 3%, barely bucking inflation and underperforming government bonds, which is hard to do, and really underperforming U.S. stocks. And the reason that is we believe the number one threat to your investment portfolio is not tariffs, not geopolitical risks, but rather unbridled emotion, right? More money is lost due to fear of what's going on in the markets, or greed / FOMO, right? The fear of missing out on the hot stock, Tesla, that went from 200 to 400 in 2 months last year and now is rode back down, right? Oftentimes we do the opposite of what we've been coached, right? We're always coached buy low, sell high, but as people react to news, oftentimes that's already priced into a stock's rise and you're buying in too late. And then of course, the other people that were invested sell, and you experience the downside. So, again, more money is oftentimes lost to emotion as opposed to financial, economic news or geopolitical events. So, our job as advisors is oftentimes to try to, coach people from a psychological standpoint to stay put and ride it out, and make sure we're not having knee-jerk reactions to the news cycle. In this slide is a way to kind of demonstrate that from a quantitative perspective, right? So anytime we're below that $0 mark, that shows people selling, right? That shows people pulling money out of the market. And anytime we're above it, that shows investors putting money into the markets. All right. So here we're showing you 3 of the most recent recessions that we've had: COVID-19, the global financial crisis, and the tech wreck in the early 2000s. And as you can see, significant amounts of dollars were pulled out. I believe this is in billions, right? So billions of dollars were pulled out during all 3 of the previous recessions. But we look at the tech bubble when prices were rising and money was going into it. So I want you to think of an analogy of your local department store, if those even exist anymore, JCPenney, Nordstrom, Lord & Taylor, whatever it might be. And if they told you they were having a sale and everything on the store would be priced at 70% off its sticker, people would go running into that store, right, to buy things at a discount, buy things on the cheap, if you will. With markets, for whatever reason, it's just the opposite. As prices come down, people run for the exits, right? They're selling. When oftentimes it's the best time to be putting money to work in reality, right? Because we're able to buy in at low prices. No one has a crystal ball, yet people often act as they do. This is very common in our profession. It almost seems like good talk to have conversations and cocktail hours about what we think about the market or what's going to happen over the next year. But the reality is we don't know, especially over short periods of time. And by missing a few of the best days, which oftentimes are during the most uncertain periods, you really, really reduce your long-term returns. And there's a really good example on this slide. If we look on the right-hand side where there's highlighted in blue, right? We're looking at what are the 30 best individual days, like what day did the stock market have the best return ever over the past 30 years since 1994. And what you'll find is, James was talking about COVID earlier, right? COVID was the most uncertain time, right? 100-year global pandemic, shut down our economies. We were all wiping down our groceries with Lysol wipes and afraid to see our families and friends. Uncertainty could not get higher, right? But 6 of the 30 best days over the past 30 years happened during March of 2020, right? On March 24th, 2020, as you can see there, the stock market returned 9.4% in a single day, 9.3% another day, right? So these are just within days of each other, within 2 weeks, right? We had markets that gyrated significantly. Unfortunately, as you saw in that previous slide, most investors ran for the exit the minute the market went down, and they never participated in that rebound, right? So what happens if you were one of those investors and you missed the 10 best days, right? On the left-hand side, you see just by missing the 10 best days between 1994 and 2024, your return decreased from 2.2 million on a $100,000 investment, this is, down to 1.04 million. So you reduce your return by 3% per year over a 30-year period by missing 10 of the best days. So trying to time the market is a fool's errand. Trying to get in and out based off when you feel, again, that's an emotion, feeling, right? When you feel like it's safe, you'll already have missed it. The markets move too quickly. No one felt good on March 23rd, 2020, when the market bottomed, but the very next day was the best, one of the best days over the past 30 years to be invested. And the number one days were in 2008, right? The great financial crisis. We had 40% declines. You had double-digit return days. So there's a saying that, sometimes, it takes weeks happen in a decade, and sometimes decades happen in a week. And it's during these, uncertain periods that decades happen during 1 or 2 weeks. And it's important to stay invested because we don't know what's to come. And I'll add on top of that, it's pretty funny. In December, so just a few months ago, when Trump won, everyone was all kind of the asset managers were putting out their predictions for the forthcoming year, and everyone, the herd is often wrong. Everyone said Trump's going to do tariffs. So if there's going to be tariffs, international stocks should perform poorly, right? Because they're going to be the countries getting tariffed, unable to sell into the American economy. And small company stocks that only sell within the US should not be affected, right? Therefore, they should perform best. And the exact opposite has happened. Small cap stocks are down the most, and international stocks are up 13% year to date. So again, no one has a crystal ball, but people often act as they do. What has been the best generator of wealth over the long term? There's really been no comparison. U.S. stocks, large cap companies, over the long run have trounced government bonds, gold, real estate, inflation. A lot of people, gold is a popular topic with inflation. If you just look over the long run here, since 1979, there's really no comparison. The right-hand side is showing you how frequently stocks outperform bonds. This slide's great because sometimes people compare the stock market to Las Vegas. And if you look at any of the popular games in a casino, the odds of winning never go over 50%, right? The house always wins is a phrase we often say. On the right-hand side, we're looking at the Dow Jones, which was incepted in 1897. So we have a lot of data in terms of how long it's existed. And we were looking all the way back to 1901. And each bar is just looking at rolling periods. So we look at, all right, 1901 to 1902, is that a positive year? Okay. Was 1902 to 1903 a positive year? Okay. So how many of those 1-year periods are positive? Then we also look at 3-year periods, 5-year periods, 10-year periods, right? So in 1 year, you already have 73% chance of having positive returns, right? Nothing like Vegas where your odds never go above 50%. 3 years, you're at 86%. 5-year, 93%. If someone were to give you those odds on a bet, you would take that every single time. There's a 93% chance over 5 years you're going to have positive returns. That's a really high probability. So there's this kind of this misnomer that investing in the stock market's gambling, and that's just looking at the possibilities. That's not true at all. It's scary times right now. There's tons of geopolitical risk in the Middle East, and we're seeing it with Russia, Ukraine. Tensions are high with in the Far East with China. We're taking over canals. This is always the case, right? There's always something going on in the news cycle. Warren Buffett has a line that we've survived 2 world wars, a Great Depression, one president being assassinated, another one being impeached, the oil and gas crisis, savings and loans crisis, 1993 bombings of the World Trade Center, the tech wreck of 2001, 9/11, the great financial crisis and the housing market unwinding. throughout the 2000s, you have like the Greek debt crisis, Euro debt crisis. We have COVID-19. Anytime you zoom in really close, right, it's scary. But if you take a long-term perspective and zoom out, the trend has been overwhelmingly upward and to the right over the long run. So sometimes we just have to ground ourselves and have a long-term perspective on things. It is scary right now, but be fearful when others are greedy and be greedy when others are fearful. These are often sometimes the best times to put money to work. This slide is the best slide in the deck. We call this the greatest chart ever. And what this is showing you is the dark blue is median annualized total return since 1989. So 36 years. And what you're seeing is the median, which is oftentimes a better stat than average, right? Because median's removing some of those huge years from the number here. So the median returns 15%, which is awesome. That's tremendous. But every year, even though the median return is 15%, right, there's a decline during that year of roughly 9.6%. We just got ours for 2025 because we were down 10% from February 17th to March 13th, right? We got a 10% decline, but that's normal, right? Volatility does not equal a loss until you sell. Think about your house, right? Your house price might have plummeted in 2008. Did you lose money on paper? Yes, but you didn't really lose money, right? Volatility does not equal a loss until you sell. So as long as we're able to ride the wave, and this wave is quite normal, look at the light blue, and that tells you how much the S&P 500 has fallen in every individual year, right? The dark blue is what the total calendar year return was, right? So just to read this to you, 2024, we had a negative 9% decline. I believe that was in August, right? But the total year return was 25%. In 2023, at some point during that year, the stock market had fallen 8%, but the full year was 26%. 2022 was a bad year. The market peak to trough had fallen 25%, but it ended the year negative 18. 2021, it had fallen at some point 5%, but it had a 29% total return. You see how this goes. The point is, every year, you should expect a 10% decline. It's normal. It was abnormal in the past 2 years that we didn't get those. That's why, as James pointed out, back-to-back years of tremendous performance, we were kind of expecting this to happen. We never knew when, but just using history as our guide, this is normal and healthy. It's almost like how forest fires clean the floor of a forest and allow for, old weeds and that to be burnt off, clear the ground for new trees to grow. This is kind of what happens. We have consolidation in markets during these sell-offs, and it allows us to kind of leg up for the next part of the cycle. The Dow Jones, this is just showing you kind of bear markets, corrections, right? So there's been 43 times where we've had a drawdown between 5 and 10%, and the recovery period is usually quite short, right? It only takes 3 months to get back to where you were previously. As you go further down, the longer it takes to recover. We just breached the 10% mark, right? So the normal recovery period would be 8 months. Before the end of the year, we, based off history, of course, we'd be back where we were. And we just crossed 10%. We kissed it. This is not a severe bear market where, there's meaningful damage that takes years and years to recover. I shouldn't say years and years, maybe 2 years to recover. It's been a very a small bear market.
I think we've gotten about a third of it back already in the last week.
Yeah. We hit 10% last Thursday, and we're already back. What are we? We're negative.
But we certainly got about 3 to 4% in the past week.
Exactly. So this is showing, what do we do with our clients' portfolios in order to help dampen or reduce the volatility, right? Bonds are a tool to use. The dark blue is a 50-50 stock bond portfolio. And you can see the range of outcomes on stocks is much, wider than it is on bonds. And lastly here, I'll just show you, this slide is called the quill chart. And this kind of shows you how last year's winners, so the top row is showing you the asset class return. So the best asset class and what was the return of that asset class. So to help you read this, in 2022, MLPs, which are master limited partnerships that move oil, right, or move hydrocarbons around, they returned 21%. They were the best asset class. In that same year, if we go to the bottom, REITs, which are real estate investments, were the worst. They returned negative 27%. So oftentimes last year's best performers are the worst performer the following year. If you look back to 2021, REITs were up 41%. So they had the best year in 2021. The next year they had the worst year, right? And this happens a lot due to performance chasing. People see something do good, they run into it because they want to participate. The next year it comes crashing down. The global diversified 60-40 portfolio, what you'll notice is it's never the best, nor is it ever the worst. It helps us dampen volatility when we stay diversified. We own all of these asset classes in what we believe are adequate amounts, and we're protecting you from these huge swings. Like I said, you'll never be the worst. You'll never be the best either. Hopefully, we can keep you towards the top of this chart. So with that, I'll pause. And James, I think we had some questions geared up.
Yeah, I just wanted to share some questions that we've been getting from clients over the past month, really over the past few weeks in particular, leading into the correction, and wanted to, share them with you because it might be on your mind as well, and give you our thoughts. And Alex, I welcome your contribution here to the conversation. But, a lot of people have been asking about, do you see a recession coming in 2025? And I would say that, a recession is a normal part of a market cycle. You usually get one every, 6 or 7 years on average. We had one back during COVID, but I would say that was a bit of an artificial recession caused for obvious reasons, the global pandemic, everything shutting down. And I do think that, it would be foolish to expect the cutback in government spending, the efforts of the Department of Government Efficiency, DOGE, and the cutback in spending, including what was previously thought of as some sacred cows, things like the Department of Defense, are also perhaps on the chopping block. I think that will have an impact. I do think the tariffs will have a negative impact on consumer spending. Essentially, a tariff is a tax not only on the American people, the American consumer, because we're going to have to pay more for those goods, but some of it will be absorbed by the companies and the countries exporting their goods to us. But it definitely will have an impact on the American consumer. So I do think it would be wise to expect a pullback, a reduction of economic growth. And Chairman Jerome Powell said as much yesterday when he had his press conference at the regularly scheduled Federal Reserve meeting. So I do think you should expect a pullback. At this point, our base case is not expecting a recession in the immediate term, but I do think we should expect a pullback. I would just, my final thought on that is to say, the market doesn't necessarily go into a bear market because of a recession, even if we were to have one. The market is a discounting mechanism, which is always looking forward, typically 6 to 9 months ahead of time. So if we actually go into a recession, the market might already have been discounting that, and perhaps that was part of the correction that we just went through, and is always looking forward to what will likely be the case, say, in the next 6 to 9 months and beyond. Any thoughts on that, Alex?
I agree with everything you said. It sometimes confuses people, I think, when they hear a recession and the stock market could be rising, because the economy and the stock market aren't necessarily the same thing. And that's the reason for that is what James just pointed out. The stock market's always looking forward 6 to 12 months. And we don't necessarily always know what it's pricing in, but for example, I agree with you, James. I think consumer spending is going to drop due to all the, aforementioned reasons, government austerity, tariffs, et cetera. But we don't know. Perhaps the Federal Reserve could cut rates, and all of a sudden that's a huge tailwind, right? If interest rates drop, usually asset prices go up, right? So there could be like secondary and tertiary ripple effects that end up, having really strong positive effects on the stock market, even though the economy's doing poorly. So again, it comes back to the asset allocation and staying diversified to capitalize on those unexpected, upticks.
I would just add that President Trump has made it clear of his desire to have the Federal Reserve lower interest rates. And I think we're up to $37 trillion of national debt. So to have that interest rates lowered on financing the debt could be a big positive towards cutting into the $2 trillion annual deficit we had last fiscal year. So I think, that tertiary kind of effect of, having a recession or an economic slowdown is actually fitting into one of the stated goals of the Trump administration. So I'll just move on to, I have two more questions I wanted to share. The second question is, what is likely to happen to the tariff conflict that we're having with our neighbors? Most recently, it's been with our immediate neighbors, or our trading partners, our neighbors, Canada and Mexico. And as I said earlier, that's likely to be expanded in early April to include Europe and the Far East, the countries that we do the most trading with. My thoughts on that are the tariff policy is a means to an end. I think President Trump is using the tariff cudgel, if you will, to get a more favorable outcome when they renegotiate the USMCA, the US-Mexico-Canada trade agreement. President Trump himself negotiated that agreement in his first administration and is looking to extract more favorable terms in a renegotiation. And I think the tariff policy that we have right now is really just being used as a cudgel to get to a more favorable outcome from his perspective. The market hates uncertainty, and right now we have a lot of uncertainty. I think the sooner we could get beyond this period of, every day, having the tariffs in the headlines, the better. I think President Trump and his administration understands this, but I think there's going to be a period of time, probably at least for the next few months, until we get to that period of certainty. I think President Trump knows he has a razor-thin majority in both the House and the Senate, and he's likely not to. I mean, I'm not making a judgment, but almost every administration that comes in with both the House and the Senate in recent memory have lost that majority in the midterm elections. So I think just like a new CEO comes in and takes over a company and tries to, kitchen sink, the tough medicine, if you will, I think that's what we're going through right now. And I think, President Trump is trying to get as much done here as he can in his mind to get the best deal possible, whether it be on trade or on government spending reductions. So I think we're seeing a lot of this up front at the beginning of his administration for the reasons I just mentioned. But I do think, we're likely to see more certainty emerge as we get into the spring and summer. Certainly by the summer, I would expect we should have many of these things sorted out. Any thoughts on that, Alex?
Yeah, I agree. I have nothing to add to that. I think you covered it.
Okay. The last question I have was, where do we see opportunities in the markets? I think you made a great point, Alex, when you were talking about, periods of market sell-offs in the past and, trying to, in every other aspect of our life, when something goes down by 20, 30, 40%, we look at that as a sale. And typically human behavior is to try to buy more when something goes on sale, yet in the stock market, it doesn't work that way. There's an emotional reaction to it. But I do see the likelihood of this rotation that we've been experiencing. As I said, we've seen a rotation from stocks to bonds, from growth to value, from domestic to international. We've seen commodities do well. We've seen a lot of other areas really do quite well here. I think that rotation will last a while longer. So perhaps we got ahead of ourselves in terms of allocating too much to the same handful of stocks that did well. And don't get me wrong, I think we really do like the outlook for many of these Magnificent Seven companies. Some more than others, but it's not that we're negative on them. But I think perhaps they ran up too much and valuations got stretched there, and many other great companies and industries got forgotten. So I think we should consider more diversification. I think the real key point and the biggest mistake that investors have made, I've been doing this for 26 years, and when I think back over my career, emotional decisions are never the best decisions. To either buy just because something's gone up 200, 300, 400%, and as you mentioned, fear of missing out is just as bad a decision as selling because something just went down. I think it's important to evaluate the fundamentals of your investment, understand your tolerance for risk, okay, and stick to your investment policy statement. If you don't have one, you might want to get one so that you could reference it during difficult times. Stay diversified. I think asset allocation is something that some people have given up on, right? I mean, bonds have been a lousy place to be for the past decade and definitely for the past 3 years. But they're up 3% this year. You could get, 4.5%, 5%, and maybe even 5.5% on risk-free investments right now, depending on the type of investment we're talking about. High-quality corporate bonds are yielding more than they have in many, many years. So, areas that maybe have been forgotten or ignored might be worth taking a look at. Single biggest thing, I think, is to stay invested, not to miss out on those days that you were talking about, over history. And sometimes the biggest days, I mean, just last Friday, after we hit that 10% correction level, was the single best day of the year. And so far now, since we hit that correction level last Thursday, it looks like the market's up today. We've been up, 4 out of the past 5 days. So staying invested is important. Using a dollar cost averaging strategy, if you're adding to an investment over time, is a great way to do it. I would say also considering alternatives. At Ramapo Wealth Advisors, we love structured investments. We have allocated most of our clients to them. We think they're very attractive risk-managed investments, especially in an environment like this where there's a lot of uncertainty. Other things like buffered ETFs, private equity, private credit, private real estate also ought to be considered as part of one's portfolio. And then lastly, I would just say maintaining a long-term perspective sounds pretty obvious, but sometimes focusing on the day-to-day is really counterproductive in our estimation because, nothing really happens within a day that should dictate your long-term goals or long-term investment approach. So just really stay focused on your long-term investment objectives and, to achieve your financial goals. So.
I think you covered most things. I don't need to rehash that. I just, I think that the individuals, investors, our clients should always approach things that there's always an opportunity, right? So if the market's, pulling back right now, what is it giving us? It's giving us an opportunity to perhaps get in at low prices. If interest rates are high, which, it's obviously detrimental and not to your advantage as a borrower, well, the other side of that coin is it's advantageous to be a lender, right? So as James, you highlighted, bonds are more attractive than they have been in a while. They're not sexy. It's not fun to own them when the Mag 7's up, 30, 40, 50%, but we're experiencing the other side of that right now, right? When Mag 7's down 20% and bonds are up 3%, like you said, year to date, it hasn't been fun to own them, but I've heard once earlier in my career that, you're not truly diversified unless you own something that you dislike owning. and it usually steadies the ship when the other things in the portfolio aren't working. So that's all I have, James. If any of you have any questions, on anything we presented today, or want to review your individual portfolio, please reach out to us, and we'd be happy to schedule that and kind of go over your accounts with you.
Yep. That's all I got. We look forward to speaking to every one of you down the line. Have a great day.